I've said before that technical analysis is usually done badly, and that anyone who disagrees with this particular image doesn't really understand the science of prediction and the science of forecasting.
We're setting a bit of a historic precedent here.
Was it really that event that caused the rally to go up?
The economy is going to start suffering pain.
That's going to be bonkers. Welcome back, everybody. Kevin Wadsworth and myself, Patrick Karim. And today, Kevin is going to talk to you about weight of evidence. What does that mean? Well, he's going to give you a lot of insights, how you could use it to forecast, how establish probabilities of possible moves. So I'll just let Kevin do his magic there and talk to you about it.
Yeah, thanks, Patrick. What I want to talk about here really is how you often see things on social media, on various accounts that are out there on YouTube or whatever, and people are often putting a lot of weight or confidence behind particular techniques for forecasting what's going to happen with a stock price or the price of gold or the stock market, whatever it happens to be. And my background is in atmospheric forecasting, and I just wanted to sort of help explain or try to explain for you the correct way of assessing and forecasting the future. Because with technical analysis, what we're trying to do at the end of the day is put the odds in our favor. We want to try and assess where the price of an instrument is going. Is it going to go up? Is it going to go down? Is it going to go sideways? What are the probabilities of that? And very often, and it's quite annoying really, very often you'll see people sort of making very bold statements, very bold claims about gold is going to go to $10,000 as if it's going to go there next year, or is it's going to go there maybe in the next 6 months, or Bitcoin is going to go to whatever, 250,000. But what are they basing that on, and how long is it going to take? And really, how should this be done? What's the correct way of trying to forecast what's going to happen with these instruments? So I'm just going to run through a couple of basic principles with you at the moment. And the first one centers around weight of evidence. Now, I've said before that technical analysis is usually done badly, and that anyone who disagrees with this particular image doesn't really understand the science of prediction and the science of forecasting. So what this image is saying is that none of these will tell you what price will do. So you've seen me draw arcs on charts. They look great, but they don't tell you what the price is going to do. You've seen me put indicators on the chart. Okay, they're great, but they don't tell you what the price is going to do. Moving averages, cycle analysis, chart patterns, the Ichimoku cloud, ratio charts, fib levels, Elliott waves, stage analysis. The list goes on and on and on. And it's true to say that none of these will tell you what the price will do. Now, that isn't the end of the story, of course. I'm not saying that these are all completely useless, okay? So the important thing to understand here is that if you take them all together, what they do tell you is what price is most likely to do, okay? So by bringing all of this evidence together, it's a little bit like a jigsaw puzzle. And if you only have one of these, if you're only looking at one of these, you're looking at one piece of the puzzle. It might be a blue piece of a jigsaw puzzle, and you say, well, there you go, it's the sky. That's the sky. And then you put the whole jigsaw puzzle together, and it's not the sky, it's the sea, or something completely different, a blue unicorn, whatever it happens to be. It doesn't have to be the sky, is my point. So just because price is within an arc and it's following in an arc, it doesn't mean that it's going to stay within that, okay? And just because a technical indicator is in a very high zone, it doesn't mean that the price of that chart can't go any higher. It doesn't mean that because the indicator is high, the only way it can go now is down, because it can stay high for a year or two, and that allows price to go up and up and up. So by bringing all of these pieces of evidence together is the only way of assessing what is going to happen. So you have to accept straight away that it's a game of probabilities. It's not a game of certainties. And you certainly won't hear me saying, I know what's going to happen with the price of gold or silver. You'll hear me saying that I have technical chart evidence to suggest that the probability of gold going to much higher values is high, that the probabilities are high, or that the probabilities are high that gold is going to enter a near-term correction. That's because the weight of evidence from these charts will be suggesting that. Now, just to expand on that and get this in your mind as well, that if you are taking the price of gold now, let's say we're at $2,500 gold, and you're forecasting ahead, you could have a scenario where gold is going to go to $3,000 in the next several weeks. You could have a scenario where gold stays at $2,500 for the next several weeks, or you could have a scenario where gold goes down to $2,000 for the next several weeks. Now, going through all that weight of evidence, once you've done it all, once you've done the exercises, once you've gone through the process, and once you've done the analysis, you could come out with 33% likelihood for scenario A, 34% for scenario B, and 33%. So you could have a very equally weighted weight of evidence. Now, if and when that happens, that's not a lot of use, because it's just like, a flip of a coin. Anything can happen because the probabilities are evenly balanced. And that is what happens quite a lot of the time. But there are points in time when it's not like that. There are points in time where the current price is about to pass through something we call an evidence cluster. Okay, it's a cluster of evidence on a technical chart that may consist of moving averages, may consist of the Ichimoku cloud, it may consist of an important resistance line. It could be a number of things. But as the price passes through that evidence area, it shifts the odds. So knowing where that evidence, that cluster of evidence is on the price chart is really, really important, because at that point in time, you are then able to say that scenario A only has a 10% chance of occurring, and scenario C only has a 10% chance of occurring, but scenario B has an 80% chance of occurring. So at that point, you've identified a point in time where you can pinpoint a scenario that is most likely. I hope you can sort of get that in your minds, because it's crucially important, that whole idea of sometimes the odds are evenly balanced and sometimes the odds are strongly weighted towards one scenario. And it's when that happens, and we had an example of this when gold broke out above the $2,000 area. It passed through an evidence cluster, moving averages, resistance lines, Ichimoku clouds, all that kind of thing. And if you look back through my social media posts at the time, at the back end of last year, we were identifying this evidence cluster that gold was breaking out of, and we were identifying a target area which equated to the most likely scenario, which is very close to where we are now. Okay, so anywhere between sort of 2550 and 2800 was a target area, and that back when price was $2,000, that was the most likely scenario, and we knew that because of the weight of evidence and because of our awareness of what was happening with the price in relation to that weight of evidence. We can take a look at something like, for example, the S&P. And the S&P, with the effective Fed funds rate, when Fed fund rates are raised or lowered, and I've marked on the points in time where the Fed funds rate rolls over when we get a pulling back of the interest rates, when we get a rotation from rising rates to falling rates. Okay, now when you get these pivots, the Fed pivots, and you start pivoting to the downside, you can look at the SPX and see what happens. Now, on many occasions, it's difficult to say that the SPX really reacts particularly at all to the pivot, but there are times in history when the S&P is either falling substantially or begins to fall substantially when these pivots occur, and I've highlighted those in red there. Now, that's interesting, but it's not, going back to my weight of evidence, it's not the Fed funds rate or the pivot that's causing the stock market to drop. It's that in association with a lot of other weight of evidence, and the biggest part of that weight of evidence is something called capital rotation, and what the S&P is doing in relation to gold. So identifying the pieces of evidence that are critically important and putting all of those pieces of the jigsaw puzzle together are what really matters here. So I just wanted to get that across. And this is how you forecast correctly. It's how you forecast with with integrity, really, because you have to accept that there are points in history or points in time when you just have to shrug your shoulders and say, well, look, the odds are all pretty evenly balanced, but it's identifying those points in time when the odds are in your favor. And if you grab those and you're aware of what's going on with the entire jigsaw puzzle, then that's when you're going to be able to profit and benefit from your trades and from your investments. And that's that, Pat.
Yeah, I totally agree. Always adapt as the new evidence comes in. It alters your probabilities, right? Just like a poker player, a new card gets turned over. He has to assess that. How have my odds changed? Do I still have an edge? If I don't have an edge, then I fold, I bail. People should exit their trades, and you get back in when the advantage is in your favor. And it's all about probabilities, because I know like people like calling these extreme outlier. Oh, look, this time it didn't do it, or that time it did that. Sure, the outlier events can always happen, but if you're in there for the long term, then you gotta respect the probabilities, and you need to always have better probabilities assessment using, like Kevin mentioned, the weight of evidence clusters. All right, guys, thanks for watching. Make sure to follow, like, subscribe, and get more cool content like this, guys. Thanks for watching.